Hi, it's Eric Nuttall, the Ninepoint Energy Strategies with this weekly update. It's been a big week for natural gas. Gas is up about 13-14% so far this week. 2026 strip is up about 3 to 4%, around $4. We've gotten a couple macro data points which we wanted to share, some of which came out of the EQT conference call. They always give a very good overview of the macro, just reaffirming a lot of the core reasons why we remain bullish on the outlook for natural gas heading into 2026. Part of it clearly comes down to weather. It's kind of funny that every year Mother Nature shows up, things get cold, natural gas starts to improve, and with it along, so do the equities. There was some commentary that initial weather forecasts are pointing to a very cold winter, potentially one of the coldest in the last 10 years. I would remind you some commentary that we got from an Energy Aspects conference in London. You know, when we look at last year, similar to now, storage levels were relatively high. We were at the top of the 5-year range, and all it took was one cold snap to bring that down to the bottom of the 5-year range. Commentary from one trader was that if we did have a average or colder than average winter, his view was that by summer of 2026, the gas price would have to go high enough to price off or price out LNG exports out of the United States, which would be significantly higher than current pricing. So that's fairly exciting. On LNG exports are hitting a recent high. As of this morning, roughly 16.5 BCF a day. EQT pointed out, we're up about 4 BCF a day, 2025 over 2024 on an exit basis. The expectation of another 2.5 to 3 Bs next year. And so it's that structural increase in demand. We had GE Vernova report guiding to very strong increase in the demand for power, specifically natural gas fired. Their order book was up 16% sequentially, 33 gigawatt backlog, 29 of what they call slot reservations in total, and they don't break down geographical breakdown, whether that's just U.S. or global. But from a U.S. perspective, that would amount to 9.3 BCF a day. So that's like 8% of total supply. It's just staggering. And so it's just reaffirming the themes of the build out of LNG, the build out of AI. Weather's always a bonus. We always assumed it's normal, but if in fact the forecasts come to fruition, strip next year's 4, I don't think 5 is out of the realm of possibility. And the leverage that we have in our key natural gas names, we prefer U.S., and that's where we're mainly exposed. At strip, our two largest weights, they're both about 10% weights each in our fund, are trading at 12 to 14% free cash flow yields at 4. The leverage to a higher gas price, just 5, $1 more, they would be trading at a 19 and 22% free cash flow yield. And so we kind of think 10% fair value, obviously meaningful potential upside in key natural gas names. And so we're bullish gas. On oil, it was a pretty big week this week on two fronts, one of which is we remain on watch for the most anticipated oil supply glut in history. Importantly, we're not seeing the evidence yet. Yes, there has been a surge of oil on water, kind of like offshore. That's the barrels held in tankers. There's a reason to believe that the relationship, it's not going to be a one-for-one, the increase in offshore and seeing those eventually end up onshore. And there's a lot of reasons for that. Even today, we have sanction risk. So there's a view that the sanctions have been essentially putting more barrels on the water, less necessarily through pipelines. And so net supply is not increasing as dramatically as some people believe. Evidence of that. So for October, so we have an army of different analysts that we use, everyone from Rapidan to Energy Aspects and others. Even Energy Aspects has been covering formally in their weekly update for the month of October. They were forecasting, Excel barrels, spreadsheet barrels, 3.8 million barrels per day built. That's like 120 million barrels supposedly going to show up in October. Onshore inventories so far this month, according to Kepler, are actually down 23. And so there's a massive delta between the spreadsheet barrels, the spreadsheet math, and what we're seeing in reality. Also importantly, Kepler, which again is one of our data providers, issued a warning earlier this week saying they've recognized an error in their estimates of onshore barrels that are being updated out next week. They're expecting a downward revision of oil on water by 2.5%. I didn't see that widely reported. And then lastly, we're having to deal with sanctions once again. The Trump administration putting on their strictest sanctions on Russia production, specifically on Rosneft and Lukoil. Halima Croft, we really respect her views, was the first out of the gate late last night with a piece identifying that their exports are roughly 1.7 million barrels per day to India, China, and Turkey. It's roughly 50% of Russian exports to those three countries. And so this could potentially have an actual physical impact. We would suggest that, the headlines of India is going to, cease to import from Russia. We're not believing that because honestly, frankly, there's no other barrels to get the barrels from. This is at a time when OPEC's spare capacity, we think at best, is 1.7 million barrels per day. There's an API differential between Russia and OPEC withheld barrels as well. And so we're bullish on oil. I'm going to say over the medium term, it's very clear that the level of bearishness we think is a little exaggerated. We remain, it's to be determined. The jury's still out. We're watching it literally on a daily basis to see that correlation between this increase in oil and water and how that's translating into onshore. So that's a wrap for this week. Thanks so much for your time, and we look forward to future updates.